Retiring in Europe is a common aspiration, but moving your savings across a border is significantly more complex than most retirees expect. While the IRS classifies a Roth IRA as tax-free, many foreign governments do not. Once you move abroad, those authorities may strip away that protection and tax your withdrawals as ordinary income. To manage this, we are going to build a cross-border retirement tax matrix, a personalized roadmap designed to organize your accounts and identify potential tax liabilities. To complete this tutorial, you need a list of retirement accounts, the exact dollar amounts of contributions versus investment growth, and your target European destination. Without this matrix, conflicting jurisdictions can legally double tax your savings. Organizing this data before you move enables you to identify exactly where those tax laws overlap. Step 1 is auditing and classifying your accounts. You must separate your assets into traditional pre-tax accounts, Roth post-tax accounts, and public pensions. Precision is required here. European tax authorities frequently reclassify what Americans consider pension income into taxable ordinary investment income, which is often taxed at a higher rate. Step 2 is the treaty test. Bilateral tax treaties determine which country holds the primary right to tax your retirement accounts. Under the default rule, countries like Spain, Italy, Switzerland, Germany, and Portugal do not recognize the tax-free status of a Roth IRA. They generally tax these distributions as local income. However, the UK, France, Belgium, and Malta have modern treaties with the US that explicitly protect the tax-free nature of Roth accounts. The specific language in these bilateral treaties dictates whether a Roth IRA remains tax-exempt or becomes a significant tax liability. France represents a notable exception for American retirees due to its favorable treaty provisions. Article 24 of the U.S.-France Treaty uses a foreign tax credit mechanism. France provides U.S. citizens with a credit equal to the amount of French tax owed, which can result in a zero tax liability on U.S. retirement and investment income. Portugal, by contrast, follows the default rule, but utilizes a split method for taxing Roth withdrawals. As this chart illustrates, Portuguese law does not tax the return of capital, the portion of the withdrawal representing your original after-tax contributions. Only the growth and earnings portion is taxable. This is treated as pension income and is subject to local Portuguese tax rates. Tracking the exact dollar amount of your initial contribution basis is the only way to accurately calculate the taxable growth in hybrid regimes like Portugal. In Italy and Spain, the lack of Roth recognition often leads to heavy taxation on all earnings accumulated within the account. This makes Step 3, strategizing withdrawal timing, essential. You must decide if a distribution should occur before or after your move date. For those moving to Spain or Italy, executing withdrawals or Roth conversions before establishing foreign residency can lock in U.S. tax treatment before local laws apply. You must also account for wealth taxes. Switzerland and parts of Spain may tax the total value of your IRA annually, even if you do not take a distribution. Coordinating distribution dates with your residency status helps prevent unexpected tax obligations based on the total value of your assets. Public pensions, such as U.S. Social Security, are governed by a different set of rules. While many assume Social Security is only taxable in the U.S., some treaties grant your destination country the primary right to tax these benefits. This leads to Step 4, dual compliance. Most treaties contain a saving clause, allowing the U.S. to continue taxing its citizens on their worldwide income regardless of where they live. You are required to maintain U.S. reporting through forms like FBAR and FATCA. Simultaneously, you must meet European disclosure requirements. Failing to report foreign accounts on local forms, such as Spain's Modelo 720, can result in severe financial penalties. Dual reporting is a mandatory obligation. Maintaining these filings is the only way to avoid government fines for non-disclosure. The completed cross-border retirement tax matrix now organizes your accounts, treaty rules, and timing strategies into a single actionable plan. While the matrix organizes these variables, international tax treaties are complex legal mechanisms and remain subject to change. Your final step is to take this completed matrix to a qualified cross-border CPA who specializes in both U.S. expat law and the specific regulations of your destination.